Okay, so welcome back to the post-lunch session. The lunch got slightly extended. So what I'll do is I'll cover whatever is possible till 5 today, and the remaining would be done tomorrow morning. Okay, but I will ensure whatever I had planned, everything will be provided to you. And this document along with the summary of notes is available in the free resources section. You can download. So now we'll move on to the next standard, which is Ind AS 105, which is non-current asset held for sale and discontinued operation. As far as discontinued operation is concerned, it is only related to disclosure where the profit or loss arising out of the discontinued operation should be presented as a net item, net of tax, and you need to give the detailed breakup in the notes to accounts. This also has an impact on EPS. Whenever we disclose earnings per share, there also we need to give the breakup. How much is from discontinued, how much is from continued, how much is overall. Alright. Now, what does 105 deal with? Non-current asset held for sale. So any item of non-current asset which is held for sale, the entity does not want to use it any further. The entity does not want to use it any further. The entity wants to sell that particular asset in the future. So that is classified under Ind AS 105. Ind AS 105 is linked to Ind AS 36. The accounting treatment is similar, just that classification is separate. Now here, one more thing you have to keep in mind, whenever there is a business combination, then non-current asset which are held for sale of the acquiree, means when a company is acquiring another company, we value everything at fair value. Whereas when it comes to non-current asset held for sale, we will value it at fair value less cost to sell. Okay, we will not value it at fair value less cost to sell. Another important thing, in Ind AS 36 we compute value in use and fair value less cost to sell. Here we will only consider the selling value. We will not consider value in use because we are not doing the valuation. In both Ind AS 36 and in Ind AS 105, one thing that you have to keep in mind is whenever you are bringing that item or an asset into Ind AS 36 or Ind AS 105, before that you have to complete all the accounting, measurement, whatever is required as per the respective standard. What do I mean by that? Say for example, there is a non-current asset item of property, plant and equipment. Before I bring it to Ind AS 105, I have to calculate as per Ind AS 16, whatever is the requirement. Then that carrying amount will be used for Ind AS 105. Okay, so let's have a look at the first question. Recognize the loss or gain on the value of disposal group held for sale from the following details. So there is a disposal group. Disposal group means group of assets and liabilities like a CGU. Okay, need not be a CGU. Here it is a group of asset. Goodwill, PPE, revaluation model, building, cost, inventory and investment in equity shares. Carrying amount on reporting date before classification, means before it is classified as held for sale, this is the carrying amount. Carrying amount remeasured just before classification. What does this mean? As per the respective standard. For example, PPE, as per PPE Ind AS 16, the value is now 4,000. Building is at cost only. Inventory 2,400. As per Ind AS 2, it is 2,200. Investments in equity share 1,800. As per Ind AS 109, it is 1,500. So this loss from 16,000 to 14,900 will be dealt by respective standard. After that, this 14,900 you will compare it with fair value less cost to sell, that is given to be 13,000. So what is the loss for Ind AS 105? That is 1,900. Okay, that is how we have to compute. This 16,000 to 14,900, that is 1,100. That loss will be handled by the respective standard. Okay, whatever the standard says, accordingly we will do the calculation and we'll charge it off to P&L. Or let's say in case of revaluation model, you would have debited the revaluation surplus. Alright. So remeasured carrying amount is there. This is what we will compute and the loss that has come is 1,900. How do we treat this loss? Same principles of impairment. So first thing, goodwill, entire 1,500 is written off. So how much is left? 400 is left. How much is left? 400 is left. Then this 400 will be allocated to PPE, building. We will not touch inventory and investment in equity shares because Inventory is measured anyways at NRV. Investment in equity shares are measured as per Ind AS 109. So those things will not touch. The remaining loss will be adjusted against PPE and building in the ratio of their carrying amount, that is 4,000 and 5,700. So carrying amount after impairment loss is 13,000. Let's look at the next one. A freehold property was originally acquired for 40 lakhs. Some years later, after cumulative depreciation of 11 lakhs has been recognized, impairment loss of 3,50,000 is recognized, taking the carrying amount to 25,500. This represents the estimated value in use of the property, value in use. Shortly after, as a consequence of proposed move to new premise, the freehold property is classified as held for sale. At the time of classification, carrying amount is 25,50,000, fair value less cost to sell is 25 lakhs. So, carrying amount is 25,50. What is relevant to us? Fair value less cost to sell, which is 25 lakhs. At the reporting date, fair value less cost to sell is 26,500. This is on the date of classification. This is on the date of reporting. After 6 months, fair value less cost to sell increases to 30 lakhs. What is to be done? First, 25,50,000 is the carrying amount. This is the impairment loss as per Ind AS 36. We will recognize it in P&L. Done. Then, when it is classified as held for sale, we will compare the carrying amount 25,50,000 with the fair value less cost to sell of 25 lakhs, which means the 50,000 of loss will be recognized in the P&L when it is classified as held for sale. Then, once you classify something as held for sale, depreciation will not be charged any further. We will see, if an asset is impaired, we will continue to charge depreciation. But if an asset is held for sale, what are we saying? We are not using it. If we are not using it, there is no question of charging depreciation. And total impairment loss, 3,50,000 plus 50,000 becomes 4 lakhs. Subsequently, at the next reporting date, fair value less cost to sell is 26 lakhs 50. Previously, we have measured it at 25 lakhs. So the reversal of 1,50,000 of impairment will be done. How much can we impair? Maximum. How much can we reverse maximum? Maximum reversal will be 4 lakhs. Here, calculation of carrying amount has had no impairment will be charged, will not be applicable because we are not using it. We are selling it. Unless the entity says we will not, sell it, we will again start using it, then you may do the revised calculation. Again, subsequently, in the next assessment, next financial year, the value is 30 lakhs, 2650, difference is 350. 150 we have already reversed here out of 4 lakhs, so maximum reversal possible is 2,50,000. So updated carrying amount will be 29 lakhs. If at all we sell it at 30 lakhs, carrying amount is 29 lakhs, 1 lakh will be the gain that will be recognized in the P&L. Okay. Then, next one. Following is the extract of consolidated statements of A Limited ended on 31st March. Goodwill asset, financial asset measured at fair value through other comprehensive income. This is as per Ind AS 109. PPE, DTA, current assets, current liabilities, non-current liabilities, provision 2250. On 15 September, entity A decided to sell the business. It noted that the business meets the condition of disposal group. However, it does not meet the conditions to be classified as discontinued operation. So, it is only a disposal group, it is not a discontinued operation. Maybe because of significance of the operation. The disposal group is stated at the following amounts immediately prior to reclassification as held for sale on 15th of September. Goodwill 200, 950, this intangible asset become 930, this became 360, 1020, 250, so on, 2160. Entity A proposed to sell the disposal group at 19 lakhs. It estimates that the cost to sell will be 70,000. So 19 lakhs minus 70,000 you will do. This cost consists of professional fee to be paid to external lawyers and accountants. As at 31st March, there has been no change on the plan to sell the disposal group. Entity A still expects to sell it within 1 year of initial classification. They've remeasured the following assets and liabilities in accordance with the respective standard. So, if a disposal group has other assets, those have to be measured as per their standard. So, financial asset you will remeasure as per Ind AS 109, DTA as per income tax, inventory as per Ind AS 2, receivables as per Ind AS 109, so on and so forth. The disposal group has not been trading well and its fair value less cost to sell has fallen to 1650. What would be the value of assets and liability within the disposal group as on the following dates? 15 September, 31st March. So 15 September we have this valuation and we'll have to compare that with fair value less cost to sell. Okay. So fair value less cost to sell is 70,000. This is given to us in the question, right? So the value will be how much? 18,30,000. What is the carrying amount? Carrying amount is 2160. So 2160 minus 1830, the loss of 330. How will we allocate that? We will first allocate to goodwill, 200 gone. So how much is left? 130. That 130 we will allocate to intangible assets. See, financial asset is covered under 109, so that doesn't come here. PPE we will consider. DTA again will not be considered here. Current assets again not considered here because we are talking about non-current assets held for sale. And also inventory, receivable and cash balances, they have respective treatment. Current liabilities we don't impair. Non-current liabilities done. So amongst these two, in the ratio of 930 and 1020 we will do the allocation. So what is the value? Goodwill becomes 0. Accordingly we will compute all the value and we get 1830. On 31st March, what happened? See, all these line items will consider as it is 1830. Then carrying amount, the question has given us what is the revised carrying amount. What is the revised carrying amount? See, this is as on 15th of September. On 31st of March, carrying amount has changed. For what all it will change? Intangible asset, it will not change because we are following 105. Financial asset, the question has given 410. PPE will not change. DTA has changed. Current assets has changed. Liabilities has changed. This has remained same. So it has become 1710. And here the value has fallen down to 1650. So what will you do? 1710 minus 1650, 60 is the loss. Again allocate between intangible asset and property, plant and equipment. Simple and straightforward. Generally we do not see many questions from Ind AS 105, but still if at all a question comes, see, once you are logically clear, you will be able to score well. And yes, these questions will be lengthy. These questions will be lengthy, and as I told in the previous session also, lengthy questions are generally easier to handle. Okay, so don't be scared of that. Let's look at the next one. S Limited purchased a property of 6 lakhs on 1st of April. The useful life of the property is 15 years. On 31st March, S Limited classified the property as held for sale. Impairment testing provides the estimated recoverable amount of 4,70,000. The fair value less cost to sell on 31st March of year 3 is 4,60,000. I don't think this is the number. This would be some frame reference number of for our animation team. On 31st March, management changed the plan and the property no longer met the criteria as held for sale. Recoverable amount on 31st March year 4 is 5 lakhs. Okay. Provide the accounting treatment for events for year ending 31st March of 3 and 4 and value of the property. So when did we purchase? 1st of April. Useful life is 15 years. Residual value has not been given. Okay. So every year depreciation is 6 lakhs. Some mistake here. No, okay. 6 lakhs, I wrote 60,000, so I was confused. Divided by 15. Every year the depreciation is 40,000. For 2 years we will get 80,000. So what will be the carrying amount? 5 lakhs 20,000. Then the recoverable amount as per Ind AS 36 is 4 lakhs 70,000. Now always remember, once we have to measure it as per Ind AS 16, it talks about impairment loss also. The carrying amount as per Ind AS 16 is the cost minus accumulated depreciation minus impairment loss. So before classification under Ind AS 105, I have to complete all of these formalities. So I will complete the formality of Ind AS 16. So the impairment loss becomes 50,000, carrying amount is 4,70,000. Fair value less cost to sell is 460. So this carrying amount I'll compare with fair value less cost to sell. So this will become 10,000. 10,000 is the loss on classification as held for sale. So 50,000 as per Ind AS 36 and 10,000 as per Ind AS 105. Total impairment loss works out to how much? Total impairment loss works out to 60,000. On 31st March, the property is reclassified as criteria is not met. So in this case, when we are doing the reclassification, I have to see if 6 lakhs was the purchase price, accumulated depreciation 80,000, impairment loss 50,000, 470. 470, after that, what would have been the depreciation that would be charged? Now, two things here, okay. We are not saying impairment has reversed. We are just saying from classification as held for sale, we are now saying it is not classified as held for sale. So, if it would not have been classified as held for sale, then our depreciation that we would have charged would be 36,000. So, carrying amount would have been 433. Recoverable amount is 5 lakhs. So, at the most, we will value it at 4,33,000. So, to that extent, from 460 to 433, to that extent, we will do the reversal. Please note, this is not reversal of impairment. This is only movement from classification as held for sale to classification as no longer held for sale. Okay. So, that is one adjustment you have to keep in mind. Let's look at this question. It was asked in exams also. Violet Limited is a beverage manufacturing company having various plants across India. There is a machinery A in the Surat plant which is used for the purpose of bottling. There is one more machinery which is machinery B clubbed with machinery A. Machinery A can individually have an output and also be sold independently in the open market. B cannot be sold. The company considers these groups as CGU and inventory of 1.65, goodwill is 1.5. So, same impairment question what we have done, right? Machinery was purchased on 1st April for 12 lakhs 60,000. Useful life of machinery is 10 years. Company expects the following cash flow in 5 years. Valuers have estimated all of this. So, same, whatever we have done in the impairment question, same thing they have asked for 8 marks in November 22. I think I did the wrong classification here. Anyways, so this should be actually a part of Ind AS 36. We have already done this question. Then the next one, company X has identified one of its division disposal group to be sold to a prospective buyer and the board has approved the plan to sell the division on 30th of September. Sale is expected to complete after 1 year, but it still qualifies to be held for sale. Normally we take 1 year criteria. If it is beyond 1 year, what difference does it make is that whatever is the future expenses that will be incurring, that we'll have to discount and come to the present value. Cost to sell of the division is estimated to be 10 crores to be incurred on March of year 3. See, fair value we are computing today. The cost to dispose of is happening after 1 year. After 1.5 years actually. Fair value of the division 400 crores on 30th September of year 1 and 31st March of year 2. And carrying value is 500 crores. How shall they be measured under Ind AS 105 on following reporting dates? 30th September, 31st March. Now, as far as 30th September is concerned, we are calculating fair value on this date. This fair value we already have. Then, what is the cost to sell? Cost to sell, whatever is given, we will incur on 31st of March of year 3. Now, what does that mean? This means that we have to discount it back. So, as of 30th September, we have the fair value. We need to discount it back and they have given consider discounting factor 10% for 1 year is 0.909 and 1.5 years is 0.867. So whatever is the cost to sell 10 crores, I'll multiply with 0.867, I will get the cost to sell. So net value will be 391.33. That is fair value less cost to sell. And what is the carrying amount? Carrying amount is 500. So a loss of 108 will be recognized. On 31st March, fair value still is 400. This has not changed. Present value of cost to sell has become 9.09. Present value of cost to sell has increased. The value is now become 390. From 391, it has become 390. The increase in present value of cost to sell is recognized as a finance cost. So, we will say this is the finance cost and as a finance cost, it will be charged to the P&L. Okay. So, that is about Ind AS 105. Similar to Ind AS 36, the concepts and all, and not frequently tested, but yes, possibility that can be tested in the examination. Now we'll move on to the next one, which is a slightly larger standard, Ind AS 116. Before that, a quick recap of some important concepts of Ind AS 116. Now, as far as Ind AS 116 is concerned, it completely works on the concept of identified asset. The asset under the lease should be an identified asset, and when I say it is identified asset, we must be able to point out and say yes, this is the particular asset, or it should involve substantial portion of the asset under question. For example, 80% of storage capacity, 90% of storage capacity. That is one more thing. The other thing is there should not be substantive substitution rights with the lessor. What is the meaning of this? The lessor should not be in a position to replace that particular asset. And when they replace that asset, when will they do it? They will do it when they have some benefits. So the lessor should not have any substantive substitution right. The lessor can't come and tell you, okay, you vacate the property, take this room instead of this particular room, take this car instead of this particular car. If that right is there, then in that case we say that there is a substantive substitution right, and hence there is no lease. Now, one very important aspect of lease is that the lessee must have right to control, that is right to get the economic benefits and right to direct the use of the asset. Whoever is the lessee must be able to say, okay, I will use it for this purpose within the overall agreement framework. Okay, I will be able to use this asset for this purpose. I will use the asset only for this particular purpose. I will decide how much to produce, how to produce, and all of that. But if a lot of these decisions are taken by the lessor or by the supplier, then in that case it will not form part of lease. And the lessee must have right to obtain substantially all the economic benefit by using it. So there are two types of benefit. One is the benefit that arises because of use. The other is benefit that arises because of ownership. The lessee here in question must be able to get all the benefits which is arising out of use of that particular asset. And of course, as we said, right to direct the use of the asset. There is one concept called inception, another one is called commencement. Inception is earlier of agreement date or commitment to principal terms and condition. This is important for determining whether the contract contains a lease or not. Accounting starts from the commencement date. Lease term includes rent-free period, includes non-cancelable period. Rent-free means if the lessor is not charging any rent, even that is included as a part of lease term. Then non-cancelable period, if there are any non-cancelable period as a part of the lease, that is included. Non-cancelable means both the parties cannot cancel. Then if there is an option to extend, if the lessee has an option to extend the lease, we will include that if it is reasonably certain to exercise. And if there is an option to terminate, then we will include only if it is not reasonably certain to exercise. Why do we need the lease term? When we calculate the present value of lease payment, we will need the lease term. Now, as far as lease calculation is concerned, we will calculate lease liability as present value of lease payments discounted at implicit rate in the lease or incremental borrowing cost. If implicit rate is not available, only then we will consider incremental borrowing cost. This is from the point of view of the lessor. Right of use asset will be lease liability plus any payments made in advance which is not included here, plus initial direct cost, present value of dismantling cost minus lease incentive. And lease payments are fixed lease payment, whichever is paid monthly fixed or yearly fixed. In substance, fixed lease payment, this is something like 5% of sales or 5,000, whichever is higher. So at least 5,000 we need to pay. So this 5,000 will be considered as fixed lease payment. Lease incentives received, will reduce it from the lease payment. Variable payment dependent on index or rate. There are two types of variable payment. One is dependent on the usage, on the output, on the sales. Okay, those are not considered as lease payment. So then what are considered as lease payment? Something which is dependent on index or rate. We'll see one question to that. Please ensure you revise both CPI based question and SOFR or LIBOR based question before your exams. Then if residual value is guaranteed by the lessee, so we have something called as residual value, which is the value at the end of the lease term. There is something which is guaranteed residual value and unguaranteed residual value. Guaranteed residual value can be guaranteed by lessee or by third party. As far as lessee's accounting is concerned, he is bothered about what he has guaranteed. So this is basically like minimum payment that will be done to the lessor at the end of the term. So for example, if the asset, the lessor cannot sell outside, the lessor can come and demand from the lessee the minimum value. Okay. For example, residual value is expected as 1 lakh. Okay. Lessee says, I will give a guarantee of 30,000. I will pay you 30,000. If you don't get a buyer, I will pay you 30,000. If you get a buyer, you go out and you can sell it. So 30,000 is guaranteed, 70,000 is unguaranteed. This is different from purchase option. Here we are not talking about option. Option means if the lessee exercises, the lessor has to sell the asset. We are also not talking about transfer. Okay. So residual value guarantee and exercise price of purchase option. If at all there is some payment to be made for exercise of the option, that also will be included. When you calculate the present value, this becomes lease liability, and this is how right of use asset is computed. Subsequently, for lease liability, we will prepare the lease liability amortization table, that is the interest expense table. For right of use asset, we will amortize it over the useful life of the particular asset or lease term. Now here you have to keep in mind, if asset is transferred, then we will always take useful life. If asset is not transferred at the end of the lease term, then we will take lower of useful life and lease term. Then there are two concepts, one is remeasurement and one is modification. Whenever there is remeasurement, you will just adjust the right of use asset and liability. You will not charge it to P&L. Now here we will use revised discount rate when the term changes, purchase option is reassessed. In these two cases, we will do a revised rate. Original rate when there is change in estimates of residual value, variable has become fixed, or when it is case of index or rate. Okay. Now here, for you to remember, okay, these two cases, the underlying substance of the lease itself has changed. For example, lease term, I have changed the lease term itself. So that is where you are using the revised rate. Reassessment of purchase option, I am saying I will purchase the lease. So again, revised rate. These are basically estimates changes. So in that case, you will use the old rate. And whenever there is a remeasurement, there is no impact on P&L. One thing you have to keep in mind. Then we have something called as modification. In case of modification, the scope can be modified or term can be modified. If scope is modified and if there is an increase in scope, if the additional right of use asset and price are commensurate, then it is treated as a separate lease. If it is not commensurate, we will remeasure the liability and adjust the right of use asset, and there is no P&L impact. Okay. So this is like remeasurement here. Then if there is a decrease, remeasure the liability using revised discount rate. So if the scope has reduced, reduce the right of use asset proportionately, and difference will be charged to P&L. Then scope, if term increases, you will remeasure the lease liability using revised rate and adjust the right of use asset, no P&L impact. If the term decreases, do a proportionate remeasurement of right of use asset, remeasure the liability using the revised discount rate, and difference is charged to P&L. Okay, this is one thing where students tend to get confused again and again. So there are 3-4 specific questions for this. Just before the examination, ensure you revise this and also those particular questions. So let's look at some questions. There are some theory questions also I have included on purpose so that those relevant concepts are also covered. Company enters into 15-year contract with power company to purchase all of the electricity produced. PQR owns the solar farm and will receive tax credits relating to the construction and ownership of the farm. MNO will receive renewable energy credits that accrue from the use. So who has the right to substantial benefit from the solar farm? Now here there are two things. One, credit. Second one is the tax benefits, etc. So since this thing, the tax credit do not relate to use of the asset but to ownership, so that part is related to ownership. And who receives the benefit from usage? The benefit of electricity and renewable energy credits is received by MNO. MNO is the customer. Okay, PQR is the supplier. Hence, because we are receiving the benefits of using the asset. So one is ownership. In case of leases, we are not talking about benefit arising from ownership. We are talking about benefit arising from lease. What are the benefit arising from lease? The electricity and the credits. Who is getting that? MNO is getting that. So in that case, MNO will say, okay, the solar farm is an identified asset. NTDA contracts with supplier to manufacture parts. NTDA designed the facility and provides its specification. Supplier owns the facility and the land. NTDA specifies how many parts it needs and when the parts are available. Supplier operates the machinery and makes all operating decisions, including how and when the parts are to be produced, as long as it meets the contractual requirement to deliver the specified number on the specified date. Assuming supplier H cannot substitute the facility, which party has the right to control the use of the asset during the period of the use? Now here, who is controlling? See, I have said I need 100 units. After that, it is up to you to decide how to produce, when to produce and all of that. So, because supplier retains operational control, this is more of a supply arrangement and there is no right to use an identified asset. I am just telling, see what happens? We are just telling how many parts we need and when do we need it. So like in case of a normal purchase or sale transaction, you tell the supplier, I need this part on this particular date. That does not make the contract a lease arrangement. Entity X enters into a contract for 6 years with entity Y. As per contract, entity is required to install an AC in its office premises. Air conditioning plant is designed as per X. To optimize the efficiency, entity Y provides operation and maintenance services on regular basis. However, entity X decides and directs the hour of operation, floors of building, etc. Whether entity has right to use the asset. Since entity X makes key decision about the plant usage, it has right to direct the use of the identified asset. Simple. This is related to CPI, variable lease payment. An entity enters into a 10-year lease of property. Lease payment is to be done at the beginning of each year. Lease payment for the first year is 1,000. Lease payments are linked to CPI, not a floating interest rate. CPI at the beginning is 100. Lease payments are updated at the end of every second year. At the end of year 1, the CPI is 105. At the end of year 2, CPI is 108. You are required to compute the lease liability at the commencement of the lease and at the lease payment is adjusted, assuming discount rate is 8%. So, lease payments linked to an index should be initially measured using the rate at lease commencement 100. So, what happens? I know it is 100. So, whatever is 100, I will consider using 100 and I will calculate the lease liability. Future changes in CPI are not considered as lease inception. What is the future change? I will not consider. Whereas, if it is SOFR or if it is LIBOR is no longer used. I know 2% every year it increases. So every year, whatever is the rate at the time of entering into the contract, by that I will increase the future payments. At the end of year 1, no payment change occurs. The lease liability remains unchanged. However, at the end of year 2, when the CPI increases to 108, the lease payments are revised to 1080 for the remaining 8 years and the liability is changed. So, because the index has changed, we will remeasure the liability and the right of use asset. Here, the LIBOR is 2%. Now, SOFR you can consider. The rate implicit in the lease is 5%. How lease liability is measured? So, here I know 2% it will increase every year. So, 1 lakh and 2% increase every year. Discount factor 5%. Calculate the present value. Subsequently, if the rate changes, then accordingly I will update the lease schedule. Entity Y and Entity Z execute a 12-year lease of a rail car with the following terms on 1st of January. Lease commencement date is 1st of February. This is relevant for accounting. Entity Y must pay Entity Z the first monthly rental payment of 10,000 upon execution of the lease, more like an advance payment. Entity Z will pay Entity Y 50,000 cash incentive to enter into the lease payable. We will reduce that. Entity Y incurred 1,000 of initial direct cost. This will be added to right of use asset, which are payable on 1st of February. Entity Y calculated initial lease liability as present value of lease payments discounted using its incremental borrowing rate because implicit rate is not available. Initial lease liability is 850. These are unpaid payments. Okay. Now, calculate the right of use asset and how you will do the accounting. 850 present value plus before commencement whatever has been paid, that will be added to right of use asset, minus incentive plus IDC will give you the right of use asset. Company H leases an aircraft for 5 years. Aircraft must undergo a planned check after every 1 lakh flight hours. At the end of the lease, Company H must have a check performed irrespective of the actual number of hours. What are the lease payments for the purpose of right of use asset? So 5 years, contract requires mandatory maintenance check. Regardless of actual flight hours, check must be performed at lease end. Company H can carry out the check or reimburse the lessor. Now here, whatever is this reimbursement that is happening, okay, now whether it will be considered as a part of my asset or not. So this is more like the preventive checks that we considered, right? So preventive checks cost, we'll add it to right of use asset, and we'll create a separate provision for the expected cost that we will be incurring in the future. Entity lease enters into 3-year lease. ABC agrees to make the following payment: 20,000, 30,000, 50,000. There are no other elements in the lease. Assume a discount rate of 12% and depreciate ROU asset on a SLM basis. How will we account for the lease? So this is basically a summary of the treatment with respect to leases. Please note, as far as Ind AS 116 is concerned, now there is no distinction between operating and finance lease for lessee. So we will calculate present value of lease payments. We'll calculate present value of lease payment at 12% to arrive at the lease liability. This is the lease liability. For this lease liability, we will prepare a table to calculate the interest expense. This is not the lease payment. This is the interest expense. This is the lease payment. Okay. Right of use asset will amortize using a straight line basis. Right. Every year entry will be for amortization, depreciation to right of use asset, interest to lease liability. Then next one, Entity W enters into a contract for lease of retail store with Entity Z on 1st of January. Initial term of the lease is 5 years with a renewal option of further 3 years. Annual payments for initial term and renewal term is 1 lakh and 1,10,000. The annual lease payment will increase based on the annual increase in CPI at the end of preceding year. For example, the payment due on 1st of January will be based on CPI available on 31st of December. Incremental borrowing rate on inception date is 5% and subsequent date is 6%. Sorry, inception date is 5% and 1st of January is 6%. And the CPI at the lease commencement as on 1st of January, commencement and as at 1st of January is 120 and 125. At the lease commencement date, Entity W does not have significant economic incentive to exercise the renewal option. In the first quarter of year 4, Entity W installed unique lease improvements into the retail store with an estimated 5-year economic life. So here, 1st of January, initial term is 5 years. So you will run it till 31st January, 1, 2, 3, 4, 5, 31st December of year 5. Renewal option of further 3 years. At the time of commencement, there is no, you don't foresee that there will be a extension of the lease term. Entity W determined that it would only recover the cost of improvement if it exercised the renewal option. What is Entity W required to remeasure the lease in the first quarter of year 4? So here dates are not given, okay, whether it is beginning of the quarter, end of the quarter. We'll go ahead with the assumption given by ICCA. Now here, first thing, initially we have 5-year term, okay, and what did they say? CPI available on the remeasurement date, that is 125, whereas at the commencement there is no CPI, that is it will be 100 only, okay, and payment on 1st of January year 2 will be based on 31st December of year 1. CPI at commencement date is 120 and 125 respectively on 1st of January of year 4. When is commencement date? Commencement date is 1st of January of year 1, okay. So you have lease payment of 1 lakh, okay. So basically what happens is 1 lakh into your 120 by 120, that's how you will do. Present value factor at 5% and present value of lease is 454. This will be a right of use asset, and 454 is your right of use asset, lease liability, and 454 is your right of use asset. Every year lease payment and interest expense, you get the closing balance. Now here, at the end of 3rd year, so when did they do the remeasurement? First quarter of year 4, means 1 has gone, 2 has gone, 3 has gone. 3 years have passed by. So at the end of 3rd year, this is 195 244 and this is 181 840. Okay, this is the closing balance. Now what happened? Whenever there is remeasurement that is happening, now after 3 years, okay, original term was 5 years, out of 5 3 years are done, 2 years are left, plus 3 years renewal, so again 5 years. So year 4, year 5, year 6, year 7, year 8, these years are there. Then what is the lease payment? Future lease payments for the new lease term using the updated discount rate of 6% we have to calculate, and CPI of 125. So you had a payment of 1 lakh into, now CPI is how much? CPI on the remeasurement date is 125, and earlier CPI was how much? CPI at the lease commencement date was 120. On 1st of January it has become 125. So 1 lakh into 125 divided by 120, if I do, I get 1,04,164. Next year also it will be 1,04,164. Sir, why did this change? This changed because the extension period is 110. So 125 divided by 120 into 110. That is why it is 1,14,583. So these three are based on revised rentals. Okay, we have inflated it by a factor of 125 by 120. So 1,04,000 here, 1,04,000 here, and these remain at 1,14,000. That 10,000 extra payment. Discounted using which factor now? 6%, because term has changed. So new rate. You get the present value. What is the present value? Present value comes to 4,91,376. Please note here, payment is due on 1st of January of year 2. Okay, so when they say 1st of January of year 2, this means this is paid at beginning of the period. So sometimes we may get confused as to whether this is beginning or end. When they are saying 1st of January, typically we can assume it is at the beginning of the period. So the revised lease liability is 491,376. What was the original lease liability? Original lease liability 194. How much is the difference? 296, 132. Add it to right of use asset, credit it to lease liability. So right of use asset will increase by this amount and continue the depreciation. Okay. Then next one, lessee enters into a 10-year lease for 5,000 square meters of office space. The annual lease payments are 1 lakh payable at the end of each year. Interest rate implicit cannot be determined. So we'll use the incremental borrowing rate 6%. At the beginning of year 7, lessee and lessor agree to amend the original lease by extending the contractual term by 4 years. Term has increased. The annual lease payments are unchanged. 1 lakh payable at the end of each year from 7 to 14. So term has increased. What has increased? Term has increased and there is no change in the payment. Incremental borrowing rate at the beginning of year 7 is 7%. How should the modification be accounted for? So first, whenever you get these type of questions, first thing is based on our original payment. Based on our original payment, what is the lease liability? So the lease liability is present value of lease liability is 1 lakh at 6% for 10 years. We get 7,35,900. So this is the original liability. For that, do I need to prepare entire 6 years or 7 years table? Not required. Whenever before it is modified, when it is modified, they modify it at 7 years. 10 year is the lease. So till end of year 6 you have to prepare. So liability, opening balance, interest, payment, closing balance. The closing liability comes to 346,355. Okay, this is what has happened. Now, what has changed? The term has changed. The term has been extended. What is the new liability? New liability is 1 lakh for 8 years. How 8 years? 7 years has 6 years has completed. We extended the term by 4 years. So 4 years original plus 4 years revised. The total term is now 8 years. So the modified liability is 1 lakh for 8 years at 7%. These present value factors will be given to you in the question. If not given, you can use your calculator. 1 divided by 1.07. How many times? 8 times. 1, 2, 3, 4, 5, 6, 7, 8. And do a grand total. You get 5.971. Okay. So 597, 100. So original liability, modified liability 597, 100. Original liability 346, 250 will be considered as adjustment to right of use asset. See, if you are, sometimes may happen that we forget. Okay, so this chart what I have given here will ensure you don't forget. What has increased? Term has increased. Remeasure the liability using revised rate and adjust the right of use asset. You have to put this into your memory. Only then you will remember it for the examination. Alright. So this is how it will happen. So this one is for what? This one is for term. Okay. Then lessee enters into a 10-year lease for 5,000 square meters of office space. Annual lease payments are 50,000 at the end of each year. Incremental is not, implicit is not known. Incremental is 6%. At the beginning of year 6 means 5 years have completed. They agreed to amend the original lease to reduce the space to 2,500. Proportionately, you have to bring it down. You have to bring it down proportionately because it is a reduction in scope. The original space starting from end of the first quarter of 6 years. So here there is a problem because they have said end of first quarter of year 6, but everything has happened from beginning of the year 6 itself. The annual fixed payment from year 6 to year 10 are 30,000. Lessee's incremental borrowing rate at the beginning of year 6 is 5%. How should the modification be accounted for? So first we'll reduce the right of use asset and lease liability proportionately in the ratio of reduction. So what has happened? See, originally the initial right of use asset and lease liability is this. Lease liability amortization schedule for 5 years, it is 2,10,000. Okay, this is nothing but present value of 50,000 for the remaining 5 years. Okay, then what is the right of use asset? Right of use asset beginning was 3,68,000 commencement. We have depreciated it for 5 years, so 1,84,000. Of this 50% is gone. So we are left with how much? 92,000. We are left with a liability of 2,10,000 and we are left with a amortization of or balance right of use asset of 92,000. Now the lease is modified to reduce the office space to 2,500 square meters. So lease payment will be 30,000 for the remaining 5 years. Rate is 5%. So what has happened? This 2,10,000 is the closing balance and right of use asset is now 92,000 from 184,000. So reduction of right of use asset 92,000, lease liability reduction proportionately half of it 1,05,000 and the difference will be treated as gain on modification. So debit lease liability, credit right of use asset, credit P&L. So firstly what we have done, we have accounted for 50% reduction. Then we will compute the revised rate. Balance payment is 30,000, discount factor 5%, we are left with 1,29,870. This is the present value of lease payment using the new rate. Okay, this and currently our lease liability should be how much? Lease liability should be 105 for the half of the period. So 129 minus 105, whatever is the difference, that will be adjusted to right of use asset and lease liability. So what we do, whenever there is a reduction in scope, first reduce the lease liability and right of use asset proportionately. Okay, as if I have given back. So I had, let us say 10 floors, I gave back 5 floors, something like that. Okay, now for the remaining 5 floors, I have changed the lease payment. So the new lease payment that has come up, using the new rate, you will compute the lease liability and adjust that to the right of use asset. Okay, so this is the second adjustment. Third, lessee enters into 10-year 5,000 square meters of office space lease. At the beginning of year 6, they agree to amend the lease for the remaining 5 years to reduce the lease payment from 1 lakh to 95,000. The interest rate implicit cannot be determined. So earlier it was 6%, now it is 7%. So first, Normal, whatever we do, right? Original liability. So closing balance of original liability is 421. Year 6, now 5 years term is left. Annual lease payment is 95,000. Borrowing, incremental borrowing rate is 7%. So the lease liability is 389. Now whatever is the difference will be adjusted to lease liability and right of use asset whenever there is a change in lease payments. Here only lease payments have changed. Here there is no increase or decrease in scope. Then lessee enters into a 10-year lease for 2000 square meters of office space. Annual lease payments are 1 lakh at the end of each year. Interest rate cannot be readily determined. Incremental borrowing rate is 6%. At the beginning of year 6, they agree to amend the original lease to include an additional 1500 square meter of space from year 6. Reduce the lease term from 10 years to 8 years. Two things are happening. The annual fixed payment for 3500 square meters is rupees 1,50,000 payable at the end of each year from year 6 to year 8. Incremental borrowing cost is 7%. Consideration for increase in scope is not commensurate. See, if it was commensurate, that was a separate lease, with the standalone price for that increase adjusted to reflect the circumstances. Consequently, lessee does not account for the increase as a separate lease. How should the modification be accounted for? So here two things are happening. Number one, additional right of use asset has come. Number two, the term has reduced. So how do we do that? First calculation is simple. Original lease liability 7,36,000. At the end of year 5, 4,21,225. You can calculate the lease liability. Then reduction in term has happened. What is the reduction in term? From 10 years, it has come down to 8 years. 5 years are done. Now we are left for 3 years. Okay. For the 3 years, what is the lease liability? That is about what we have to ask. Basically, what we are saying, earlier we had 10 years lease term. Now that lease term has come down to 8 years. 5 years are already done. 3 years are left. For the 3 years, what is the liability at the beginning of year 6? At what rate? At original rate. That is 267 3 years. So we are saying 3 years liability should be 267 300 only. Okay. How much is the liability? 421. How much it should be? 267. What is the difference? 153. Similarly, right of use asset 736. 736 has now become how much? Divide by 2, 368. Out of that 368, for 3 years, how much should be the right of use asset? 220,800. So you have to reduce the right of use asset by 147,200. This difference will be taken to P&L. So first we are accounting for reduction in term. We are accounting for reduction in term and proportionately reducing the right of use asset and the lease liability. Alright. Then scope has increased. We will take the new lease payment, new rate, and what is the liability. What is the closing liability? 267. The difference will be adjusted to right of use asset. In the study material, they have given slightly elaborated computation of the thing, but final net impact is the same. Okay. If at all there are low value asset and we opt for exemption, this has to be done on SLM basis. Don't forget this. Low value asset and operating leases for the lessor, you will do it on SLM basis. So here 2000, 2500, 2100, totally you will divide it by 3 and every year you will account for the expense at 2200. Balance will be accounted for as lease equalization reserve or lease receivable and lease payable. This is one thing where students tend to forget in the examination. Then whenever we have lease component and non-lease component, what you will do is either you combine it as a single unit of account and do the accounting for it, or you separate it. When we separate it, we will take stand-alone selling price. What is the stand-alone selling price or what is the stand-alone value? Based on that, we will separate between the lease component and the non-lease component. Next one. Entity X is an Indian entity whose functional currency is Indian rupee. It has taken a plant on lease from entity Y for 5 years to use in its manufacturing process. It has to pay annual rentals of $10,000 every year. On the commencement date, exchange rate was 68, average rate for 1 year was 69, and at the end of year 1, the exchange rate was 70. Incremental borrowing rate for USD borrowing was 5%. How will we measure right of use asset, lease liability initially and at the end of the year? Initially, present value 5% is 4.39, payment is 10,000, so we'll measure it at 43290 USD. And what is the exchange rate? 68, so we'll measure it at 29 lakhs 43,720. Subsequently, we will prepare one USD schedule. So this will be the USD lease liability. What is the closing balance? Opening balance 4329, interest 2164, closing payment 10,000, closing balance 35. We will value this at closing rate. Why? Because as per your as per Ind AS 21, we will account for it using the closing rate. Okay, so that is 2481,815. Then my INR amount of lease payment was what? 2943. Okay, how much should be the interest? Interest will charge using the average rate, so that comes to 2164 into 69, 149. Payment we made at the end of the period as 7 lakhs because we have paid $10,000 into 70. Closing balance is 2393. So 2481 is the restated balance. 2393 is my book balance. The difference between this and this will be charged to P&L because as per my INR books, my lease liability is 2393. As per restated value, it is 2481. Difference of 88 is debited to P&L. Okay, so that's how we'll do the accounting. 17 related to the transaction where we have a sale and leaseback transaction. Very, very important, which you should keep on revising as well. Entity seller lessor sells a building to another entity for cash of rupees 30 lakhs. Immediately before the transaction, building is carried at a cost of rupees 15 lakhs. At the same time, seller enters into a contract for right of use of building for 20 years with annual payment of 2 lakhs payable at the end of each year. So there is a sale and leaseback transaction. In sale and leaseback transaction, you have to be very careful of one adjustment related to the market value or fair value adjustment. For example, here, what has happened? Here, the building is carried at a cost of 15 lakhs. It is sold at 30 lakhs and the fair value of the building at the date of sale is 27 lakhs. Now, why will someone buy a building which is worth 27 lakhs for 30 lakhs? For example, I am selling the building to you. Building has a fair value of 27 lakhs. You bought it for 30 lakhs. You paid me how much extra? 3 lakhs extra. That 3 lakhs extra, why will you pay me? In future, I will pay you higher rental. So, that 3 lakhs extra what you have given to me is like a financing arrangement. So, what the standard says, you got 3 lakhs extra, split that. 30 lakhs split into two parts. 27 lakhs for your lease and 3 lakhs for your finance. And this you account for Ind AS 109. This is like a loan taken and 27 lakhs is the actual transaction that has happened. Okay. Then the interest rate implicit in the lease is 12% per annum and buyer classifies the lease as operating lease. This is important because if it is a finance lease in the books of buyer, then in that case control has not passed, the control test fails and we will account for it as a financing arrangement. Okay. So here what has happened? 30 lakhs is the consideration, 27 lakhs is the fair value of the building and 3 lakhs is for financing. What is the carrying amount of the asset? 15 lakhs. If you see 15 lakhs of the asset and 30 lakhs, actual gain is 15 lakhs, but we will not consider that as the gain. Whatever amount we have received, we will consider only 27 lakhs as fair value of the asset and hence gain will be only 12 lakhs, 27 minus 15. Extra 3 lakhs will be considered as a loan transaction. Okay, so 2 lakhs is the amount payable. This 2 lakhs includes lease as well as loan repayment. If you calculate the present value at 12%, you get 14,94,000. This 14,94,000 is the present value of lease payment. Present value of lease payment or present value of total payment. How much is the present value of loan? 3 lakhs. So balance will be considered as lease liability and this will be considered as corresponding right of use asset retained. We'll see how do we account for it. Okay, I am repeating once again. Present value of payment is 1494. Present value of loan is 3 lakhs. The difference is considered as 11,94,000, which is the lease liability. Okay. Now, whatever payment we make of 2 lakhs will be split between 3 lakhs and lease liability. So, if you divide in that ratio, that is 2 lakhs what we are paying, partly it will reduce the loan value and 11,94,000 will go against reduction of your lease liability. So what we will do, 2 lakhs divided by 1494, that is the present value, into 3 lakhs. That 40161 is for loan payment and balance 159 is towards lease liability payment. Okay. Then for the seller's book, total fair value of asset is 27 lakhs. Total fair value of asset is 27 lakhs. Now here, because there is a sale and lease back, I am not transferring the full right. I am retaining the right for 20 years. What is the value of that? 11,94,000 is the value of that. 11,94,000 is the value of that. So 27 lakhs is the fair value of asset transferred. 11,94,000 is the right of use asset which is retained, and hence we have transferred only 15,06,000. So the total gain of 12 lakhs I cannot recognize. I will recognize gain only to the portion transferred. That is, I have transferred 15,06,000 divided by 27 lakhs. I get 55.77% into 12 lakhs. So my gain will be only 6,69,333. And out of total 12 lakhs of profit, the portion which is retained is 530. On that I will not recognize any gain. Okay. So how will we do the accounting for it? We have received 30 lakhs cash account debit. Out of that, liability is 3 lakhs. Done. Then asset has a carrying amount of 15 lakhs. We will de-recognize that. Then right of use asset will not be based on 11,94,000. It will be based on my current carrying amount only. That is, what is the percentage I have retained? 44%. So out of the cost, 663 is retained. So I will recognize right of use asset as 663. Liability 11,94,000. Balancing figure is profit on sale 669. This is one thing where a lot of students don't revise, thinking it's a very complex question. But if this question comes in the examination, we must be able to do it in a straightforward manner. Okay. As far as the lessor is concerned, they will debit the building account by 27 lakhs, financial asset 3 lakhs of loan, and bank what they have given, accordingly they will do. And subsequently, they will account for an operating lease transaction. Okay, as and when they receive the lease rental on a SLM basis, they will recognize the thing, and for loan, they will recognize the income. Okay, so this covers the leases related part. I don't want to stretch further to again put a strain on the throat. Tomorrow we will complete the remaining standards, most likely early in the morning around 7:30 or 8 what I'll start. We'll notify you half an hour before, or you can come back subsequently and also watch the recorded lecture that is available. If you liked it, do drop in a like and also share it with your friends. I hope this quick revision of all important questions will help you build confidence for the examination. And the idea is, in your preparation time, in the last 4 days that you have allocated, because now you have got a glimpse of all the questions, you should be able to quickly revise the entire standards that we are talking about. And this document, you can keep it with you handy, because this covers all the important points from all the standards that will be relevant for you for the examination. See you tomorrow. Hopefully my throat gets better and I'll be able to complete in the balance about 3 hours of time that I'll allocate. I should be able to complete that. Alright. Thank you and have a nice day.